The global economy is going to a deep recession. That's what the IMF recognized this week. How is that going to impact your farm? Mike Zuzolo is going to tell you. This is Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Mike, it seems that the IMF is watching all of this pandemic all over the world, and just now they are figuring out that the crisis will be a lot worse than any previous recession we have lived.
Yes, and that's not a surprise because in their April update, Luis, they did talk about another scenario, a worse scenario where we didn't recover quickly from the COVID-19 and we had more of a W or U-shaped type recovery. And it is looking more like a W-shaped recovery in their opinion. And they did take world GDP for 2020, this current year, down to -4% or -3.9%. And that was almost 2 percentage points lower than what they had given us in their June outlook and or April outlook. And compared to their January outlook, we've had almost an 8% shift from a positive 4% to a negative almost 4% GDP. So the trend is definitely getting worse. And when you say, what does that suggest for, you ask the question, what does that suggest for our farming clients and our ranchers and our grain and livestock producers? I think it continues to suggest that the demand, while it will continue to recover, it's going to be slower than what we wanted. And the energy markets are going to remain in focus. Those energy markets, after this IMF update came out this week, it made me think of the energy markets a lot more, thinking that if unleaded gasoline demand and diesel demand in the United States and China especially slow down again, that will have ripple effects and repercussions throughout the currencies and throughout the other commodity sectors. So that and the interest rates, I think the interest rates are something we're really going to have to watch closely, because even with that kind of a negative GDP figure that they gave us, the developed countries are now surpassing debt levels not seen since World War II, and developing countries are now hitting, in terms of public government debt, they're now hitting levels not seen ever before. They've taken out the old record highs of government debt and public debt seen back in the 1980s. So we've thrown all of this money at a recovery, and it's still not able to give us what we need in terms of demand growth based upon their update. So this time period heading into July 4th, you and I have talked about a lot. It's real important.
Yeah, what's the most beaten commodity?
I would say the most sold commodity, just based upon the Commitment of Traders report, would be the corn, the maize. That has been the short side of spreads when it comes to buying beans and selling corn. I don't know if you noticed this week, but the new crop November beans against the December corn, that ratio has now spiked to 2.65 beans premium to the price of corn in December futures. That is a new record high for that contract. And this is in the midst of going into the acreage and stocks report, where the vast majority of the trade, including myself, think that corn acres are going down and bean acres are going up. But the trade is clearly more in favor of buying beans still and selling corn. So they've been buying beans, selling corn, buying wheat, selling corn, buying feeder cattle, selling corn. All of these ratios, these spreads, are very discounted in the corn and very premium to those other commodities. So corn, clearly with that 3 billion bushel carryover in the United States and ample world wheat ending stocks based upon USDA's last 2 months of supply numbers, would suggest the corn is the best sell out there. So if there is going to be a shock to the upside and a demand play or a weather event, I would think the corn would have the most upside.
But it seems that there are two sides of it, but because in one way they are recognizing the deep that this recession is going to go, but the other side of this, it seems to me that we are getting close to recovery, as you always mention. We are just less than 2 weeks away from the summer grilling season. Less than 2 weeks away from the 4th of July. So it seems that the recovery is coming. Another important point for corn growers in the U.S. is that the Brazilian corn crop will be reduced, and there is big demand for the domestic market in Brazil. So there won't be as many exports, corn exports in Brazil as last year, a record export year.
I think you bring up a massive point, Luis. And I spoke to another media person in Iowa earlier this week, where their crop is really probably going to be a record at this stage, unless they have an early freeze. They've had tremendously good weather, and the market is taking note of that. But I think you bring up a really big point. The long in the corn market is going to be weak. He's not going to want to stay in the market if technicals don't hold or if he gets bad news. We've seen that this week. We've essentially gone 17, 18 cents lower in just since last Friday in corn futures, almost all on crop conditions improving and on the rains expected to come in the upcoming weekend. Why is the long so weak in corn? It's because of what you're talking about. The government agencies continue to promote a very big supply of wheat globally and a very big, comfortable supply of corn globally, so that the feed grains as a whole look like we have so much that any weather event we may have is still not going to really change the net supplies, that they're still going to be burdensome. Until those government agencies change that mindset and start to reduce some of these crops, like in Brazil's corn, Europe's wheat, Russia's wheat, Ukraine's wheat, there's many areas they could reduce, in my opinion. But until those official government agencies do that, I think the funds will continue to want to sell the corn and make it the short side of spreads. That's something I picked up and learned about 2 years ago. It really doesn't matter what you think as an analyst. It's what the government agency thinks, because that's how the funds trade. They trade the government numbers, period, end of story. So that's where we're at right now. We haven't really changed our dynamic for over 2 years now.
And if you can go deeper, what's the huge contrast between wheat and corn right now? Because the market is a lot more bullish for wheat.
Yeah, they're bullish to a point, and that's because the world wheat price in the United States is down. The soft red wheat is down to $200 a ton. And they're also seeing the hard red wheat on this very small record low acreage base see the cash market start to find support. And as we've gotten into western Kansas and gotten towards Colorado and gotten closer to the Nebraska-Kansas border, we have indeed seen yields start to come down based upon most reports I've seen. So the dynamic for wheat is simply that it is farther along in harvest, and therefore the funds are probably more likely to cover their shorts first there. When I go back and look at the wheat versus the corn, it typically is that the wheat leads the market. It puts the highs in first, it puts the lows in first, and then the corn follows about 30 to 45 days after that, typically speaking. 2012 was different because the drought missed the wheat, but it really hit the corn and beans. And so corn went higher and wheat went lower that year. But most years, wheat leads the corn both up and down. And this is not just because of the feed grain issue of wheat and how cheap it can get to compete with corn. It's also because of the currencies. The wheat usually follows that dollar very, very closely. So when the dollar's lower and weakening, the wheat finds the most support off of that.
And with the grilling season starting there in the United States, do you think there will be significant improvement for the meat markets?
I think there will be at the grocery store grill level, but these spikes in COVID in Texas and in Arizona And some of these key major metropolitan states, because the spikes are occurring with increased hospitalizations, Luis, I'm very nervous that they're going to have to go back on their phase and go backwards in terms of containing the spread by not allowing people to come out again and go to restaurants and be able to eat out again. So that's probably the most concerning thing. And the market's picking up on that right now. And I think that's a key element to not just the stock market, but the beef market as well. And that's going to affect the global beef market at this point. If we do see the United States and Brazil and Europe and China start to have to walk back their opening up because of COVID, that's really going to hit the institutional markets. Colleges around the United States are very close to opening. That is a massive source of demand when it comes to institutional meat consumption at those universities and those cafeterias. So that's going to be a really big issue in the next 30 days.
How often are you hearing weather speculation? Because every day I read about a different issue. I read that the west of Nebraska is getting drier. I read that North Dakota is getting wet. So, do you think this crop is going to be as good as the USDA is saying?
The clients that had not gotten any rain in the last 2 weeks that were really starting to worry about their crop permanently being damaged, about 50% of them received about an inch of rain. So they're okay for another couple weeks. The other 50% are expected to get rains this weekend and early next week. I think if we don't get that rainfall this coming 5 or 6 days, and then we head into the acreage and stocks report and there aren't any bearish acreage or stocks numbers that USDA gives us, I think we could set ourselves up for that traditional short covering rally going into July 4th holiday. And that's really what I'm talking to clients about who have both old crop corn in the elevator or on farm stored or with basis contracts, as well as when do you start hedging your new crop corn. We're really in the heart of getting a short covering rally based upon weather and a neutral or friendly USDA report. Those are our best opportunities as I see it in the next couple of weeks. But that 50% of those people, those clients that have not gotten any rains, Luis, they're telling me that they will have permanent yield damage. And the Western Nebraska comment you made really resonates with me. One client told me just this week that if he doesn't get rain, even with irrigation, his yields are going to be worse than 2012 because of his stands. The spring was hard on him. His emergence was not that good. And now he's facing a really short corn crop that's not getting enough moisture.
From the middle of the United States, Mike Zuzolo. Thank you.
Thank you, Luis. Have a good week.